Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate, with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glen Sutherland. This week my guest is Chris McEvoy. Chris, if you want to start off by telling people a little bit about yourself, and we'll jump into it.
Yeah, thanks very much, Glen. So our firm is Leap ACT. We're located in Fonthill, Ontario. I'm a Canadian CPA specializing in cross-border taxation. We have Canadian clients. We also have some U.S. clients. And the vast majority of our cross-border work is coming from people who are Canadians investing in U.S. real estate, although we do have a fairly good number now who are also doing things like immigrating to Canada or emigrating from Canada or establishing U.S. businesses or expanding their Canadian business into the U.S.
Yeah, and full disclosure, Chris is my accountant and does all these wonderful things for me. So the reason I got you on this call is I reached out to my coaching program and asked them, like, what are some of the big questions if you're going to sit down and talk to an accountant? What are some of the big questions that would be really helpful to understand? And the one that stood out to us was, what's the best way to pay yourself from a U.S. company, right? So people trying to figure out how to live off of this income the proper way from rental properties or flips in the U.S.
Yeah, that's a great question. And I'll give a very accountant-y answer, which is it depends. It largely depends on how they're structured. So, for instance, one of the big key differences is, are you invested, let's say, via an LP structure only, or do you have, let's say, a Canadian company which owns a U.S. company and so far down the line? If you're structured just as an LP, each year you pay tax on the revenue minus expenses. So those are essentially tax paid dollars. So there's no tax ramification for taking withdrawals from your LP. So you're not taxed on what you take out of your LP, you're just taxed on what that arrangement made every year. And so, whereas if it's the corporate route, it's a little different. One reason we typically will tell people have a Canadian entity owning your U.S. entity is that taking a dividend from a U.S. entity is very inefficient. Same thing with putting yourself on payroll from a U.S. entity is typically very inefficient. What would end up happening is, let's say you lived in Canada but had a U.S. entity and paid yourself a dividend, you will have paid potentially 21% on the U.S. side, and then you're going to pay another 20 to 50, so call it 30 or 40 points, depending on your Canadian tax bracket. You could be up to round trip almost a 50 or even a 60-something% tax. So there are definitely wrong ways to do this. So this is why this is a great question. Whereas if you can have some sort of Canadian side entity, doing management fees to your U.S. entity or, bringing income back up through that chain, and then let's say you're a Canadian resident receiving Canadian dividends or Canadian payroll from a Canadian company, that's much more efficient and you'll pay much less round trip. So a simple way to kind of remember this is that it's, Canadian resident, Canadian company, Canadian dividends. So typically, if all that's happening on the same side of the border, you're usually best to compensate yourself from an entity on whichever side of the border you live. So if you wanted sort of a short Coles Notes, that's typically the right answer. Obviously, talk to your accountant because it varies. It depends what your tax rate is in Canada. And of course, it depends if you're a tax resident of Canada or a tax resident of the U.S. Because if I had a U.S. resident asking me these same questions, my answer would be totally different.
Yeah, I love those depends, because that's honestly what happens. I know I was just talking a week ago with one of my students, and he was talking about taking a dividend from his U.S. company, but putting the dividend to go to his Canadian company. Based on what you just said, it sounds like that's not the most efficient way to do it through a dividend, to move it from the U.S. company to the Canadian company. Are you looking to invest in the U.S.? Are you looking for a coaching program that will actually save you money and help you avoid mistakes? My students get discounts on lawyers, attorneys. If you're looking to get an E2 visa, if you're looking for certain software, if you're looking to even speak with CPAs, I have discounts for all these things. If you want to just get on a quick phone call and we can discuss if it's a fit for you, 10-minute phone call, go to glensutherland.com or at CanadianInvestingInTheUSA.com and book a call.
So that can be okay. So the worst one is if you take a dividend to yourself as an individual. Canada doesn't give any preferred dividend taxation rates the way you normally would get from a Canadian company. So a dividend from a U.S. company to an individual is taxed really the same as your wage income or your T4 slip. Right, so it's very, very inefficient. Whereas if you're going company to company, that's not so bad. Typically, what happens is that there's a withholding from paid to the IRS. Typically, that's 5%. Although that was one of the things we talked about in the Big Beautiful Bill a few weeks ago, is that there was some suggestion that those rates could change at some point in the future, depending on what the two countries do and so on. But assuming we're still just going by the tax treaty, then it's 5%. And then in Canada, there may be some corporate level tax to pay on all that money coming back. There may not. And so oftentimes that can be pretty efficient. So essentially it would be something like 5% to move those dividends from USCO to CanCo. And then, you pay yourself out from there as an individual. And this all sort of assumes that you've maybe already explored doing a cross-border management fee or some sort of cross-border interest charge, which those two may actually be even better than the dividends. It's just there's more rules around them and they require more justification and so on.
Love it. Well, Chris, I think that was a great explanation. If you were listening to this episode and you were kind of confused or you had additional questions, maybe you should reach out to get a consultation from Chris, which he does have a fee for. But if people wanted to reach out to you, if they wanted to become, work with you or get a consultation, how do they do that?
So they can go to leapact.ca, fill out our web contact form. And if you are a student of the Canadian Investing in the USA podcast from Glen Sutherland, then please make sure you mention that, since all of his students are receiving a 50% discount from our normal consulting fees.
And we are checking, so Chris does send me a text. Anyway, Chris, like always, thanks for coming on the show. I really appreciate you sharing your knowledge, and I think everyone's going to learn a little bit every time you're on here. Thank you so much.
Always a pleasure, Glenn. Thank you.
That was a nice video. Bye.